Welcome back to the weekly report. I know it's late, but this has been the most boring market ever, and there hasn't been a lot of opportunities. I've been making some trades here and there, but overall, this has been a very slow week. My finger, though, has been hovering over the buy button because out of all this chop will probably be a very profitable trend. And I will share one trade that I have already set up in anticipation of that trend. But the big things that I wanted to cover today are the Tesla news that screwed up my Friday idea for a good trade, which was a breakout on Tesla stock that we did not see because of this news that came out. And the other thing I want to cover is a Twitter thread that I really liked, and I think you're going to like it as well, from RJR Capital. So as soon as this article was released, it caught like wildfire. Everyone was sharing it. The rumor that Elon Musk is to step aside at Twitter and Tesla. We've already gotten confirmation of him leaving Twitter. This was actually confirmed by Elon himself, welcoming the new CEO. She will be starting in about 6 weeks. He's also put out an announcement that he will do a live Twitter Spaces so that people can ask her questions. We've already seen a lot of speculation around this person. Apparently, she used to have some level of involvement with the World Economic Forum. I've seen different reports to what extent that involvement was, but a lot of people don't like them, right? If you're more right-leaning politically, you hate them, all right? They're the secret people who pull the strings behind everything that are slowly ruining the world. And I would, at least, I think the grain of truth there would be that they do generally suck. If you're left-leaning, though, you also hate this because Elon's still in control. And so for the people who are freaking out on the right side, I think it's good to remind them that Elon still owns the company. So if she does something out of pocket that people don't like, he can just fire her and get someone new or step back in. Now, for the rumors about Elon leaving Tesla, that's where you have my attention, because I think that's a big deal. Because Elon leaving Twitter should have been really bullish, and that was my setup for today's trade, actually. I was like, well, calls into Friday, the stock looks like it's on a breakout. It should, if he's leaving Twitter, he'll have more attention drawn to Tesla. Everyone's aware of this, and the stock's relatively cheap by its own historical measures. It's still a very expensive stock to buy. We'll go kind of over that in a moment when we go over this other Twitter thread that I think is really good. But the big deal here is that none of this is actually new information. It's a bunch of the same rumors that we've been hearing for a while now. Pretty much ever since Elon hit a blunt on the Joe Rogan podcast, we've been hearing rumors that the board would try to push him out. He's doing too many things. He's not focused on the company. Again and again and again. If you bet against this guy, you're likely going to lose your bet. But it does have an odd timing as he looks to be stepping away from a lot of projects, starting a new AI company called X, and also pushing a bunch of new waves of projects with SpaceX, with some recent breakthroughs in there that could be significant enough that he wants to focus more of his attention on that. Tesla itself has also reached a level of maturity where, hey, they're the number one automobile company. I actually don't think it would be a big deal if he left, because when we heard those previous conversations in the past, we already heard about him potentially replacing himself with the CFO as the new CEO, right? And the correlation that they draw in the article that I think is actually pretty accurate is that this is his Tim Cook, all right? He's Steve Jobs, the creator of Apple, and this is his Tim Cook, the guy who's not going to come up with these crazy revolutionary ideas and change the world as we know it, but who is going to run this company like a tight ship and be fairly conservative with maintaining its position. And I think, hey, that's a pretty good guy to have at this point in time. Tesla's just waiting for this technology to catch up to it as far as the self-driving goes. As soon as that happens, I think that they're ready to dominate. Now, as for the rest of this article, a lot of this is just nonsense. This is claims that he screams at employees, but he considers himself clear and concise. It's just a bunch of the same Elon hate that we've seen time and time again, especially from more left-leaning people that want to paint him as this evil capitalist whose dad owns an emerald mine somewhere and he came into a bunch of money. None of this is true at all. The most rampant emerald mine is complete utter nonsense that's just factually wrong. It has no grounding in reality whatsoever even. But like people ran away with that rumor, we've also seen the writers of this article also run away with some other rumors that don't really matter at the end of the day. It doesn't really matter at all. And even though this has caused an emotional sell-off in the stock, the market's pretty bloated anyway. So I think we need some sell-offs all over the place. I don't think it's very significant. And even the sellers here, these are probably some paper hands. It's not a big move out of the stock by any means at all. And I don't think that this is going to be long-term bearish for the company as well. But he will still have a significant role at Tesla, even if he is not the CEO. And speaking on how the market generally needs a sell-off, let's also cover this Twitter thread by RJR Capital, and he's even calling this one of the most important threads he's ever put together. I thought it was a really good one, significant enough that I wanted to feature it for this weekly report because there really wasn't a lot of other things to talk about, honestly. Some of this may be a review of things I've previously said, but I think it's different and more specific, so I just wanted to cover it. A while back, he shared a thread about the concentration risk in equity markets. You know, so many people are piled into the big tech companies. We could see, you know, Microsoft, Apple, Amazon, Nvidia, Alphabet, Tesla, Meta. These are not new names, right? And they've been holding up the indexes while the rest of the market melts down. And he says, we all know that a large amount of passive flows support these mega cap stocks, but they didn't amass such huge weight in the indices because of the passive bids. They'd have simply retained their weights if passive were the only bid. And what he's saying there, so passive bids would be like your 401k automatically buying the market, right? And everyone has these big tech companies built into it. They're blue chip stocks, they're classic names. And if it was just passive money in these, then they would have passively sold off when the market did, when interest rates rose. This is classically what we see happen within the markets. However, what's going on here is a little different. Active money flowing into these stocks have given them their outsized weights in the indices, and active money continuing to bid them have driven their relative valuations higher as index valuations have dropped. So the S&P has come down, but these companies have continued to grow, keeping, you know, the S&P generally up, right? And that's because active hedge fund managers don't look like an idiot not holding the top companies that continue to perform year over year. You can't be underperforming as a hedge fund manager and then not be holding these companies, or else you just look like an idiot, because everyone will just say, well, why didn't you have Apple in your portfolio when you're a technology fund? You look like an idiot. So it forces you to buy these stocks, even if you don't think it's that great to hold right now. And remember, you know, if you're a big hedge fund, you can't just go completely cash when you want to. I think most even more aggressive funds can go at max 50% cash. They can't go entirely cash, even if they think the whole market's going to sell off, because they are legally obligated to follow their prospectus. A lot of people don't understand how the more professional side of finance works, but this is how it works. This is why an individual like me can consistently always beat the hedge funds. I'm not upheld to some prospectus that is then checked by the SEC to make sure that I follow it to the T, okay? Because I don't manage a fund. That is the advantage you have as an individual. He continues to say the S&P 500 trailing 12-month PE was 35.96 when the index peaked on January 1st, 22. It is at 23.91 today, still high, but down 33.5% from its peak. And we expect this. Last time Fed funds rate was high, S&P 500 was around, PE was around 18. And let me just interrupt myself real quick and explain what a PE ratio is. Okay, this is evaluating the stock price to the actual earnings of the companies, price to earnings, right? It's the amount that an investor is willing to pay for every dollar that the company makes. So if the S&P index has a P/E ratio of 18, it means that investors are willing to pay 18 times the earnings that the companies within the index make. Okay, if you're willing to buy something with a 38 PE ratio, then you're willing to pay a premium based on the future profitability and growth that is likely to come from the companies that underlie the index. It doesn't have to just be the index, though. It could be for an individual company, right? And Nvidia sitting at ridiculous P/E ratio, and you're willing to pay that. It's because you think that they're going to have monstrous growth in the future. So you're willing to pay a premium for the P/E ratio. So that's significant, right? We're still almost double where it was last time the Fed's fund rate was this high. Fed's fund rate is based largely off the interest rate, right? So last time interest rates were this high, we had halved what the S&P is currently at. So, I mean, if you're bullish right now, I'd be really worried about what's going on, because this doesn't add up, right? So how has big tech fared? Here's a snapshot. Apple at 29 PTE, now at a 29.47. So it's only gone up. Microsoft was at a 35.39 and now it's at a 45.74. Okay? So we're already almost double what the previous PE was. And still, Microsoft has actually climbed even more rather than coming down as interest rates came down. This should be extremely worrisome. Google was at a 25, now at a 35. Meta was at a 24, now at a 40. NVIDIA was at a 63, now at a 164 PDE ratio. Amazon at 51, now at 267. And Netflix and Tesla are the only two with lower PDE ratios today. Massive. Massive. It shows how much money is seeking a safety within the big tech companies that is desperate to get some returns and not look like an idiot for not holding these stocks. And I don't think enough people are paying attention to how significant that is. This is huge risk. This is where all the risk is. You know, oftentimes people will say, Josh, why don't you go into this super popular trade or that popular trade? It's because these popular crowded trades tend to blow up on themselves because the market realizes that's how it can take the most money out of it. All right. And you have to also remember that if you're at the head of the Federal Reserve and you're trying to fight inflation, part of that inflation battle is psychological. And so you need to destroy the wealth effect. If the index stays high and a lot of my money is in my 401k and I see that it's doing great and performing great, even though market has come down, I still feel rich. And so the Fed's job is to kill that feeling of feeling rich and to cause people to save money, to bring these prices down, to slow down demand, to cause a recession. And to do that, they're going to have to kill these stocks. And they're likely not going to stop until they see them actually get killed. And so even though that these big tech companies have been the ones to overperform for now, I think we might see them lead to the downside as the market starts to turn over. And I think this is what could cause a potential double bottom around the 350 range for SPY index, or could even cause return to the pre-COVID highs later this year, if not starting that process at the beginning of the summer. I think we could already be signs that we're seeing that rollover occur now. And that's why I say, even though the market's been really boring right now, there hasn't been a lot of big moves, no real clear trends. If we go in the Elliott waves, we're going to look to be an ABC corrective, and it's a sideways corrective wave. Gross to try and trade that. It's not very fun at all. If you're a pure day trader doing intraday moves, maybe you've had some good luck. Typically, I'm not doing a ton of that. So I'm doing some of it, of course, but not a ton of that. So I haven't liked any of this at all. Even the intraday moves have still been pretty muted as well. So if we make 18% here, 20, 30, 40% maybe. It's still not a lot of moves, right? It's not the type of returns I want. So what's on the other side of this, though, is probably some big moves, some big trends that are going to be a lot easier to spot and to chase. And that's where you can make a ton of money. And speaking of those new trends, I'm going to go ahead and talk about that trade that I said at the beginning of the video I'd cover. We're going to do this real quick because the videos are getting way longer than I anticipated. But let's go ahead and take a look at Costco. We have this 5-wave pattern set up on the Elliott waves with a triangle formation. These usually have very strong tendencies to play out. We have A, B, C, D, E, all staying within the parameters of the triangle. And what we're looking for now is a breakout to the downside on the stock. If we look at the TTM squeeze on the weekly and the daily, they're both rolling over. And if we also go on a larger time frame and look at the Fibonacci's, look for where the pullback could be. This stock could be going all the way back to 390. So I've bought some 3-month contracts all the way out to July. If you want to know what the exact strike on those are, you of course got to be a Discord member. But that's the trade I got set up. I think it'll be a very profitable one. It's one of the larger trades that I have set up right now. I have many on the books, even some bullish stocks that I like right now. I'm looking at some energy and some miners, and hey, there's a company that makes all the transmissions for all the EV vehicles, not just Tesla. It's a pretty interesting one. There's another company that's involved within all the solar power companies. We just had that solar power special, so maybe you want to hear about that. It's all in the Discord. And thank you to all the members that have been in the Discord and new members as well. We've had some really great growth there, especially on Twitter and stuff. So make sure you check that out. If you want to hear more, make sure you follow the YouTube. If you want more YouTube videos, if you like and subscribe, it would be awesome. I will see you on a future video when the market is finally not boring.